Welcome, my name's Jeff Driver, General Manager Business Development for Australian Foundation Investment Company. Have with me today Mark Freeman, the CEO, and David Grace, the Portfolio Manager from Australian Foundation Investment Company. Mark, we've just announced the full year result after the 30th of June, which showed a 9% increase in profit when you exclude the merger dividend, I should say, last year between BHP Petroleum and Woodside. What were the main elements in terms of the increase in underlying income that drove that increase?
Sure, thanks Jeff. Well, the big increase was with the banks, so we've had improvement in the dividends we received from those, and banks are still an important part of the portfolio in terms of generating franked dividends for our shareholders. We had an improvement on Woodside, and also we'd added JB Hi-Fi over the last 12 months or so to the portfolio. That produces very attractive franked dividends as well.
And I guess in that context, we are able to overall increase the dividend for the year.
Yeah, we look at the dividend from a one-year perspective. So in that regard, we actually this year increased the interim dividend. We felt there was an imbalance. If we look back last year, we were paying a 10-cent interim and a 14-cent final. We've increased that interim, so it's now 11 cents and 14 again, but we still see that imbalance between the interim and dividend. So it's something that the board are thinking about, and we will want to address that going forward.
I guess the other feature of the result was the low MER of 0.14%. Just want to comment on that?
Yeah, well, we think 0.14 is very attractive for shareholders. The company's run for shareholders, it's owned by shareholders. There's no performance fee on that, so we're really pleased that we continue to produce a very low cost for all the owners of the company, which are the shareholders.
Thanks, Mark. David, the past 12 months has been an interesting market. Quite challenging for investors. We had the resources sector up 23%, information technology up 38%, and on the other side of that we had healthcare only up 9%, and other parts of the market well below the average for the index. What were the main drivers of the market, and how did AFIC perform in that context?
Sure, thanks Jeff. So the portfolio performance was 13.9% when franking's included, and that compared to the ASX 200 return of 16.6%. There were two main drivers about the portfolio underperforming the broader market. So the first of those was a sell-off in a number of high quality companies, so that's the likes of Mainfreight, Transurban and ASX. And just for context, these are companies that delivered really strong performance in the 2 years prior to last year, and companies where we feel the earnings prospects still remain strong, so have actually added to ASX in the recent sell-off. And secondly was a strong performance in the resources sector that you mentioned, and as shareholders be aware, our exposure to the resources sector is primarily through BHP and Rio. And what really drove the performance of that sector last year was just at the smaller end of the market, so smaller resource companies. And if you think about what we're trying to deliver for shareholders, we don't expect to have a large exposure at the smaller end of the resources, and that's really for two main reasons. The first is they don't typically pay a strong dividend yield, and where they do, it's small and inconsistent. And then secondly, just a really poor track record that those companies have about allocating capital as they look to replace their finite assets. And only in the last week we've had two of those companies report large write-downs of acquisitions that they made within recent times.
Adjustments made through the year. I mean, it was a very strong market, as we just spoke about, in certain areas. What adjustments, or how did you look to manage the portfolio through the year?
Yeah, well, as you know, we look to be low turnover, just cognizant of the impact that tax has on our performance. However, we do want to be able to take advantage of shorter term buying opportunities, and equally look to trim some holdings where we feel they're trading at excessive valuation. So in that regard, we trimmed some Brambles during the year, we trimmed Iris, we also trimmed some banks after a really strong run, and also took some capital out of Ramsay Health Care, Amcor and Transurban. In terms of sales from the portfolio, we exited Orica, InvoCare, Temple & Webster, Reliance Worldwide and Ryman Healthcare. And just to generalise across those names, we just felt that the competitive intensity for those companies is set to become particularly more pronounced than what we've seen recently, and we didn't feel that was reflected in the share prices. And then where that capital went, it was largely within existing holdings within the portfolio that we looked to make larger, just capturing those shorter term buying opportunities. So the larger buying was in the likes of BHP, We added to NAB on the back of that sharp pullback. We saw that get down to really attractive valuations where the dividend yield is quite strong. We also bought Domino's Pizza, IDP Education, and added to CSL recently, given the sharp fall in that share price. And we just feel that's now trading at a level that doesn't reflect the excellent long-term prospects for that company.
Thanks, David. So, Mark and David, any general comments about the market conditions and what we sort of look to expect potentially over the next 12 months in markets?
Yeah, look, we're starting off a bit more cautious. We don't think the market's sort of grossly overvalued in a broader extent, but we see pockets of overvaluation, we think. And the economy's held up pretty well overall to the rise in interest rates, and certainly there are areas of stress starting to appear and some weakness, but generally companies have adjusted to this new environment pretty well, so the reported results are still being okay. But we still think there's probably a broad-based slowdown occurring, and in that regard we're cautious that pressures might come on companies to maintain margins and profitability, and so we're really in a market where we think you've got to be patient and I guess wait for prices to come to us. So we certainly have a shopping list of companies we'd like to own more of. It's been pretty typical of the AFIC approach over the years, and we're going to be patient. Let's see where prices move to, and if stocks that we like come in within our price range, we'll look to add, but we're not sort of chasing the market, as it were.
And Dave, you have any further comments to
Yeah, just adding to that, just feels like the market's very much driven by macroeconomic forces, so around inflation, where interest rates will likely peak. So in times where market is driven by the macro, you see lots of volatility in share prices. So as Mark's talking about, just having the opportunity to capture those value opportunities they present and making sure we're recycling capital through the portfolio to be able to capture them as and when they arise.
Thanks, David. Well, thanks, Mark and David, and thank you everyone for joining us this morning. Thank you.